Pacific Private Money, California's premier private lender. We're going to get into that in just a minute as to what premier private lender really means. Today's show, it's going to be interesting. You're going to understand what mortgage investments are and how you can earn, get this, 8% or more in a conservative investment environment. All right, so right now I'm going to turn it right over to Mark. First of all, who is Pacific Private Money?
Well, Pacific Private Money is short for Pacific Private Money Loans, and we're a real estate lender. And we're like a bank, except we use private capital to fund our loans. And the private individuals who invest in the loans we make earn exceptional returns, oftentimes 8% or more every month.
Okay, so you're mentioning about mortgage loans. The show's named Mortgage Investing 101. What is mortgage investing?
So mortgage investing is when you are the bank. So you have your savings, sitting in a money market account, earning all of 0.25% if you're lucky.
If you're lucky.
If you're lucky.
And you tie it up for 7 years.
Right,
Go ahead.
exactly. And so we take people's savings, and like a bank, we fund our real estate loans. So I mentioned 8% paid monthly. It's actually 8% annualized returns paid monthly because the borrowers make monthly interest payments.
Which is kind of interesting because 8% per annum is 0.67% per month.
That's more than
more than a 5-year CD. But
yeah,
okay,
right,
all right,
exactly.
Okay, so individuals come to you and they invest money with you, and what do you do with that money? You lend it out just like the bank.
So we serve companies like Pacific Private Money serve two types of clients. One are borrower clients, people who can't get a bank loan, and we'll get into why certain borrowers can't get loans from a bank.
Okay.
And then the other clients are our investor clients, those that provide their savings to us. We use that money, we pool that money together to make loans to real estate investors or other people who need typically fast financing that they can't get from the banks.
Okay, and let's just get right into that also. The first question that I'm thinking, I'm the audience out there and I'm listening to this question, I'm saying is 8%. I mean, why are any borrowers borrowing at 8% when the bank is charging maybe 4 or 5 or even 6% interest?
Well, and to be frank, they actually typically pay more than 8%. So a lot of our borrowers, our average loan that we write is at 10%. So the question is, who would pay 10%? Right, exactly. Well, quite frankly, a lot of people would, and a lot of people have, and a lot of people do. And for example, we serve real estate investors in the real estate investment community. If you remember what happened in 2008 when the beginning of the financial meltdown, when real estate prices imploded, the banks stopped making those crazy loans that they used to make in the early 2000s. The money pool basically dried up for real estate investors.
Yes.
Now, real estate prices went down. There were a lot of foreclosure opportunities for people to buy homes now that were foreclosed upon and remodel those homes and sell them at a profit. That was a very common method for real estate investing. Actually, it still is. There are not quite as many foreclosures as there were in 2011, 12, and 13, but there's still plenty of real estate activity going on. But now they can't get the money from the banks. So where do you go? So lots of companies like ours, like Pacific Private Money, sprung up in 2008, 2009, 2010 to address this new lack of capital in the marketplace. I mean, the pendulum swung the other direction. In 2005, virtually anybody with a decent credit score could get a loan.
Oh yeah,
and
they were
everybody
lending.
Was getting a loan.
100% financing sometimes.
And in fact, companies that were in the business that we're in now were typically back then making seconds and land loans and development loans. It was a different business environment prior to 2008 and the real estate market correction. In this new environment of Dodd-Frank regulations and banking restrictions, banks are only making loans to a certain segment of the population, leaving a fairly significant part of the population without access to capital. But these are good borrowers. These are people who have a short-term need for money. They're going to buy a property, they're going to remodel it, they're going to sell it, they're going to make a profit. We provide financing for them. Also, there are people who no longer qualify for bank financing today, but might in 6 months or a year as they clean up their credit. We also provide financing for them in the term of bridge loans that allow them to acquire real estate, and then they pay us back with a conventional loan, once they qualify.
Well, you're mentioning real estate investors. What about homeowners? Do you provide for people per their personal residence?
We do. In 2014, we probably did 2 to 3 dozen loans to people who were in contract to buy a house. They were pre-qualified with their mortgage broker, and something happened during the 30-day escrow period where they discovered the bank wasn't going to be able to close. Sometimes something comes
Like
up
what?
last
Yeah.
minute. Well, scores drop sometimes unexpectedly. We had one case where there was a tax lien, IRS tax lien, that was filed during the escrow period. It turned out to be, it was wrong, but they still had to clean it up. Or we had a situation where we recently funded a loan for someone who was employed, and he kept moving his money around in different bank accounts, and that scared the bank, and they backed out last minute. In each of these cases, there were deposits from the buyer, from the borrower, that had gone non-refundable, and these people were going to lose their deposits, so they needed fast access to capital, a fast bank loan that would close the transaction. Then once they owned the property, they would refinance it in their own time, whether it took 2 months or 6 months or 12 months. They now own the property, albeit it's an expensive loan, it's 10% money.
But they don't want to lose their non-refundable deposit.
Right, compared to
and
losing
the property.
real estate,
Yeah.
right. So one thing to point out, we haven't touched on this yet, we're not making 100% finance.
I was going to ask you, how risky are these loans? Because the loans that were done back, 2005, whatever, especially on a house, you could put down, 3 or 4 or even 5% and get a bank loan for the rest. That's to me, is a risky loan.
Absolutely.
What kind of loans are you doing?
So I said earlier that our investors get to be the bank, but they just earn exceptional returns, 8% or more. But unlike the bank, we don't make 100% loans. We don't do like the 97% with a 3% down, or the 95% with a 5% down. We rarely go above 70% of the cost of the property. Not 80% like a traditional bank loan, but 70%. We're actually more conservative than the banks are because, again, we're using private capital, and we have a new, better business model post-crash in this new Dodd-Frank era,
well, also,
where we believe we make loans that are conservative with safety and security features built in.
Well, also, from 05 to 08 and 09, 10, and 11, prices kept dropping significantly, and now they've rebounded. Question is, how are they going to drop completely off the cliff again? And how much can they drop? Who knows?
Well, you make a good point, and so that was one of the reasons why, for example, in 2008 and 9, we wouldn't go above 60 to 65% loan to value because there was fear that the market
prices
was going to continue to go down, which was exactly what happened. Prices continued to go down in 8, 9, 10. In most markets, the bottom was right around 2011. So after that, it's been going up, and now we've gone from 60 to 65 to 70%. Now, there are borrowers that are asking for higher percentages, and the pressure is there from the borrowing side. Hey, can you do 75 or 80%? But most of the time, we pretty much stick to our guns on that. We stick with a fairly conservative loan to value because we just don't know what's going to happen. We don't know if we're going to have another cycle again, and maybe prices pull back 10 to 15%. We want to make sure we've got what's called protective equity. Protective equity is the difference between the percentage you finance and the percentage cost of the cost of the house. So at 70%, we've got 30% protective equity. That's solid.
Yeah, let me add one thing. There's that part of it, but there's the other part of you want the borrower to have what they call skin in the game.
Absolutely.
So if someone's put up, let's say it's $1 million piece of property, and they're putting up $300,000, and they're asking you for a $700,000 loan, that $300,000 is real money that they could potentially lose. So even if the price of the property drops, which we've seen a lot in, specifically in California where prices dropped, but the borrowers, especially if it was their own house, even if they were underwater, they still wanted to pay. They didn't want to lose the property.
Absolutely.
So, okay, so
your point, we want to make loans that are not going to default. That's the whole point. And in fact, we've made nearly 1,000 loans since 2008, and we've had just less than a dozen foreclosures. And that is an amazing statistic when historically the percentages are actually higher. They're anywhere from 2 to 3%.
Well, the banks,
on
what,
average.
it's what, 5%? I don't know exactly what the banks are, but it's got to be high.
Between 3 and 5%, depending on the market cycle. So we want to generate loans that have safety and security features, have protective equity for our clients, because our goal is, again, we want protection of principal and we want exceptional yields. And we do that by making real estate secured loans to borrowers who have what we call a viable and reliable exit strategy. And that's important. So we're not making long-term loans, we're making short-term loans. The typical loan term we make is 6 to 12 months. They're usually paid back within that time. Sometimes we make 2 or 3 year loans, but that's the exception, not the rule. That's generally in a case where someone's credit has been so beat up because of foreclosures, but they've recovered in terms of their income. They're just not bank financeable right now.
Okay, very good. Something we forgot to mention when we opened the show is that at every commercial break, we're going to ask a trivia question. And we're going to ask for people to email the answer to info@mortgageinvesting101.com. We're going to choose from among the answers we receive randomly, and then we will give you a gift. And that gift is going to be a Visa card that has a limit, $20 or $50 on it. And what we're going to do here is, here's the question. Okay, here's the first email question. The song Over There came from which war? Over there, if you remember that song. Okay. I'm no Enrico Caruso or whatever. Okay. All right, so go ahead and email the answer to info@mortgageinvesting101.com, and we'll announce the winner the following week, but we'll tell you the answer coming up here pretty soon. When we come back, I'm going to ask Mark for a specific example of a loan that you recently did. All right? So stay with us. You're listening to Mortgage Investing 101. I'm Edward Brown, Mark Hanf, and you're listening to, again, Mortgage Investing 101. We'll be right back.